layout. My name's Rebecca Hoskin. I'm with the Reptelis Novak Group. I'm going to let my colleagues here introduce themselves. Go ahead.
Hi, my name is Monique Sharp. I'm the Assistant General Manager for Finance and Administration for the Township.
How's everybody doing this evening? I'm glad to see so many interested parties in this section over here, but I am John Anthony Brown. I'm the Treasurer of the Board of Directors.
I'm John Bruce. I'm the Fiscal Services Manager for the Woodlands Township.
All right, so I have several questions. I'm just going to start going through as quickly as I can. If we can answer them tonight, we will. If we need more time or need to do some research, we'll have to do that later.
You have to speak into the microphone so we can hear you.
I am. I'm trying. Okay. Sorry about that. So we've got a couple of questions. And Mr. Chumley, do you need me to read yours or? Okay. He's asking for ratios to be done now, last year, ones that are certain, and for 5 years for a 5-year plan projection with incorporation and without incorporation, some ratios to be done mathematically. Excuse me, you need to make room for the camera. I apologize. And so this is a mathematical thing, so I'm going to put it aside for now, but we've asked for some ratios to be done in several different types. Okay, regression analysis. Again, we can't do that tonight, so I'm going to put that off. There was an update to the revenues, well explained. What updates were made to the expenses? How do we know that all expenses are a city budget for a city and not a city budget for a township? Texas Municipal League cites a reduction in volunteers, increase in residents' reliance on the city rather than itself. So it seems there will be a culture change over time, and these changes mean either increased expenses or reduction in things the residents do. Therefore, there's a difference between a township with parts of a city budget added in from a city with a city budget. I think my response to that would just be, as Jonathan mentioned, you're already doing 90% of what a city does, but Monique, do you have anything on that?
No, I don't. We can look into that further, but Jonathan just went over that in great detail. So we do feel like we have captured all the cost based on our current assumptions for a city and not a township.
Wouldn't franchise fees likely be passed along to residents by the companies paying them, e.g. through higher electricity bills, etc.?
That is certainly a possibility. The fact is we do not know right now. We have reached out to multiple utility companies. We have not been given a definitive answer. So I know some people assume that will happen, and I'm not going to say your assumption's wrong. What I am saying tonight is that I can't tell you definitively one way or another. That is just something we do not know at this point in time.
That's not true. That's not true.
County? No.
As far as we know, the county is not receiving any franchise fees. So we are aware in one instance of where the development company is receiving one, but again, we don't have all of the information.
Okay, next question. If we don't incorporate and we release the incorporation reserve, how much can our tax rate be reduced?
Your tax rate can be reduced zero if we release the incorporation reserve, because under accounting practices and according to board policy and governmental accounting, you have to have ongoing revenues to support ongoing expenditures. A reserve is a one-time balance. So once you use up that reserve, you do not have any continuing funds to be able to do it. So by policy, by best practice, by governmental standards, one-time sources of money such as reserves are used to fund one-time types of expenses. So what the board has typically done in the past is used it to reduce debt, use it to fund other reserves, or use it to fund capital purchases.
Does that make sense to folks? So it's sort of like if you got an inheritance at home, you can't increase your expenditures to be like that every year. The inheritance is gone. You won't have it the next year. Does that make some sense?
I wrote that question.
Okay.
And it was the incorporation reserve.
Uh-huh.
Also, not incurring the $60 or so million of annual costs. So if we don't incur those costs, how much would
So, well, I can't answer that question. The purpose,
Sure, the clarification he asked was, he's saying if the increased $16 million in operating expenditures that's part of incorporation, if that were not to occur, could the tax rate be reduced by releasing that reserve? Is that correct, sir? Okay.
so the whole 16, so first of all, you have to remember that there's offsetting revenues to that. So it's not a whole 16 million. So you would have to take the net cost. The net cost of about $6 million. I can't answer that question. That is a board decision on what would be done with that funding. So I don't. So again, that's not the purpose of this whole exercise was to determine how we would use funding to incorporate. So that's what we are concentrating on. We can run that calculation, but that's not something that I am able to do tonight.
The next question I have is, what percentage of tax dollars currently paid by Woodlands residents stay here now? Do you know that?
I don't, if I can get clarification, is that federal or county?
Federal or county? To the county.
To the county.
So we know what percentage of county
Does it-
tax dollars paid by Woodlands residents stay here now? Does anyone know
No.
that?
We can try to find that out, but I don't have that tonight.
What is the plan for a... I'm sorry. You okay? What is the plan for a massive recession worse than 2008? Inflation is rising, labor shortages, money supply is high, interest rates are low. What happens if we go off a cliff?
We have operating reserve account at $30 million right now. That is the whole purpose of an operating reserve. Our operating reserve is set around 25% of our annual operating expenditures. So that covers about 3 months worth of operations. Beyond that, we would do just like we would do for any natural disaster. We would start looking, as if we were experiencing a great loss in revenues, we would start looking at expenses that we would need to reduce. And we would look at those in terms of which would have the least impact to services provided to the residents. So it's just a natural, it's something you would do in your personal life. It's something that any city would do. If you have that type of disaster, you're going to look at globally at everything that you can do.
Okay. Why not save money from not incorporating and give a tax cut?
As I mentioned, the purpose of this presentation is to talk about how we would fund a city. So that's the exercise that we have gone through, and that's what we're going to talk about tonight.
Let's see. Is there a way to reduce costs and expenses? And is the 5-year plan, does it show cash flow deficit or surplus?
The 5-year plan shows we try to never. The whole purpose of a 5-year plan is so that you are looking at what you're doing now so that you do not incur a deficit. So we don't prepare plans that show deficits. So it does have what we call revenue capacity or favorable variances. So certainly that is what is built into our 5-year plan. That's just conservative budgeting. That is, again, what is required by best practices.
Would an over 65 property tax freeze the rate or the total tax? Can the freeze be rescinded?
That's a good question. The property tax freezes the amount you pay. So your tax rate has to be applied evenly to all taxpayers. So that doesn't change. But so whatever the year of qualification, if you are paying $500 in taxes that year, that is your frozen amount. Your tax can go down. So if the tax rate goes down or the appraisal of your home goes down, your tax rate could go down to $450. But the most that it will ever be is $500 unless you have significant improvements to your home. So if you build a pool, you add a room addition, something like that, then that additional value will be captured. But absent of that, the amount is frozen.
Thank you. The focus seems to be on the sale with no discussion on assessment of property values and expectations. I believe. I'm trying to read the writing, sorry. So it's just saying that it's on the sale of homes with no discussion on reassessment or revalue? Is that yours? Okay, yeah. Okay. Uh-huh. Right. So the question is really saying that the focus of our discussion has been on the sale and the rate versus the reassessment and the revaluation. And
Well,
so we have addressed that in the projections. So
Yes, so that was part of the presentation tonight. So what we have, our projection is a 2% revaluation, is what we call revaluation. So that the 2% means the existing value of your home would increase by 2%. And so on an average value home of $460,000 in the Woodlands, a 2% revaluation equates to $20 a year. So that's what's included in the 5-year plan.
is that every year?
Yes, it's a 2% revaluation every year.
And that's based on past, is that based on past history?
Yes, and that is based on some years we've been lower than that, some years we've been higher than that. But if you look over average and you look at current trend and what the real estate industry is projecting, that is the amount that we used.
And in fact, I believe the 2% is conservative and below the real estate projections, correct?
Yeah, actually it's lower than the real estate projections.
You're using an estimated cost for shift to a city model. What happens if those costs are not accurate and actually higher?
Well, again, we have revenue capacity. We have capacity built into our budget. We have reserves that we can use. We can adjust expenses. It's a constant. I wish I had my graph here. It's something that the directors and the board of directors every year in the budget and the budget workshops go through. So a budget is very fluid. I mean, I'm not going to sit here and tell you that we know what's going to happen next year, much less 5 years from now. And one of my favorite sayings is the day that I publish the budget, it's obsolete. I mean, that's just a fact. So we have many components. We have reserves, we have debt service, we have property tax, we have other sources of revenue, we have expenses, we have capital. And as things change, as revenues change, if expenses go higher, whatever the condition is, we constantly balance all of those elements. We have over 2,000 elements, different elements in our budget. So that's something we do. Not just the week of budget workshops, it's something we do daily, is continue to monitor all of that.
Are there any assets currently owned by the Howard Hughes Corporation that we will have to or want to purchase upon incorporation?
Not that I'm aware of, no.
Not that we're aware of, is the answer. What happens after 5 years?
Well, I wish I knew. So again, we can only go based off of current trends. When we look at trends, we don't just make those up. We look at industry guidelines. We work very closely with the comptroller's office. They do a great job of looking by region throughout the state of Texas. So we based our trends on that. What we tend to do is after the 5-year plan, the further you go out, the more uncertain it gets, right? I mean, I think it's the same for all of you personally. I don't know that you could say exactly what your finances are going to look like exactly in 7 years, most of you. So what we do is we go more conservative. So you saw the projections tonight, which are conservative. As we start building our plan out even further than 5 years, we're going to even go more conservative in our revenue growth, in our expenses.
Yeah, go ahead.
Same basic model. There's like people that are saying, "Oh, everything's just going to go up after 5 years," but you stick with the same model.
It's the same, yes.
So the question, it was her question, and she's saying she's curious about the freeze in the tax rate. Does that continue after the 5 years?
Oh, yes, because I didn't answer the other part of that question. I apologize. That once a tax freeze is implemented, it cannot, by state law, it cannot be rescinded. So Well, and again, that's our 5-year projection. That's what we typically do because after the 5th year, you get way more uncertain. We do have our capital plan is based on 30 years. We have a 10-year projection, which I just said that where we go even lower. But the reason we're focused on the 5th year here is that's where the full cost of transition are implemented. And then after that, I can tell you, we didn't go into all that. We did that at budget workshops. But for instance, in the year right after, after the 5th year, we have we have debt being paid off, and we have an economic development zone where the sales tax frees up. So we already know we have about $350,000 of revenue coming in there. So anything big like that, we continue to project out. And the most important thing for us is, I mentioned earlier, the ongoing operating revenues have to cover ongoing operating expenses. So all of our trend lines, all of our projections make sure that we're maintaining that where revenues are outpacing expenses.
So the question is, if the expenses are much higher than anticipated, will the tax rate jump?
Well, okay. Well, first of all, the tax rate, there's a state law, and by law, the property tax rate can only increase by 3.5%. This gets complicated, of your no new revenue maintenance and operations rate. But if I break that all down, the maximum increase, tax increase that we can do for 1 year without voter approval equates to about 0.007 cents. So, and for on an average value home, that equates to about $32. A year. So that's maximum without voter approval. Anything else, anything, yeah, we have to go to the voter for anything above that 3.5% cap.
Okay. Since we will transition law enforcement over, they had already allotted funds for pensions. When we acquire those employees, will we pay, say, for them at the same rate as they were designating before? I don't see where pensions for all staff, including law enforcement, is included in the models.
Currently, the contract that we have with the Montgomery County Sheriff's Office and with the Harris County Constable's Office, we pay all salaries and benefits that are being provided to them by their current employer, the counties. So to the extent that they have pensions right now, we are contributing the same amount into those. So there's no difference in terms of our assumptions and what benefits they will receive.
Who will
When you say salary and benefits, it's like healthcare and pensions, even for the new employees we are going to bring on. That's also included in the amounts of projection.
Yes, ma'am. She's asking if even with the new employees, if those same level of benefits. So you're right. It's health insurance, their vision, their pension plan, retirements, it's everything they do. We pay 100% of the salaries and benefits that they are receiving now, and that is assumed throughout the model.
Okay, who will appraise property values going forward?
The Montgomery County Appraisal District and the Harris County Appraisal District have are the only legal authority in order to provide the appraisals.
Isn't it disingenuous to say no tax increase first because you suggest keeping the mill rate flat? People care about the amount of the check they have to write, not just the rate. And weren't we already being taxed for incorporation before we even voted for it, a $21 million fund incorporation and $107 million in reserves?
Okay. Okay. Well, let me take that second one. First. So weren't we already being taxed for incorporation before we even voted on it because of the $20 million incorporation reserve? Because we currently have $107 million in reserves right now. Yes. So we do have $107 million, or actually that's the wrong amount. I know that amount's been printed, but that's actually not the amount we have. But it's close. It's around 100. So no, you have not been taxed to build up the incorporation reserve. That reserve was funded by favorable sales tax variances and favorable expense variances. So you can go back in our budget, you can go back into our audited reports, and you will never see where there has been a specific allocation of sales tax or property tax dedicated to the incorporation reserve. What happens naturally in any budget, and actually the consultants talked about this, is we budget conservatively. We don't want to overstate revenues and we don't want to understate expenses. So naturally, the township and any local government, if they're doing their job right, is going to have favorable variances at the end of the year, right? You're going to not spend, you're going to probably have more revenue than you budgeted, and you're probably going to have less expenses than you budgeted. So what we do is and the property tax is the certain amount. That's the one amount we know because the tax assessor gives us the amount. We know the certified roll, we know the rate we're applying. That amount is certain. What varies is the sales tax. So, and typically, again, we're conservative. We can historically have had more sales tax revenue than we budgeted, and historically we have spent less than we budgeted. Those were the monies that were used to fund the incorporation reserve, but only after the board of directors used it to pay off debt that was callable, any callable debt. They used it to fund budget initiatives, which are basically when residents during the annual budget process, we invite them, the village associations, to submit projects, and we fund, and that's what the board uses to fund those, and capital projects.
So you've already explained it, but
Yeah.
you can explain
Yeah,
it.
okay, I'll
This
explain.
is the same question as previously. Why do we keep the $20 million for incorporation reserve versus give it back as a reduction in tax?
A reserve is a set amount of money. It's just like a savings account that you have at home, and you can redesignate it to one-time purposes. You cannot use it to fund ongoing revenues or expenses like a tax rate would be, because a tax rate happens every year. So once you use up the reserve in 1 year, say we used up all the $20 million in 1 year, well, no, we didn't. And I'm saying the one choice would be to reallocate that somewhere. What I'm saying is you can't reallocate it in order to reduce the tax rate. Okay.
No, she's explaining that there are policies and rules that prevent that from occurring, essentially. Is that correct?
Yes.
Okay.
You're right. You can budget less conservatively, but there's an impact to that. First of all, we have a policy. Secondly, we follow GFOA, Government Financial Officers Association guidelines. We budget how our credit analysts expect us to budget, and all of that says there's something called an objective budget, an objective projection, and a conservative. And we try to go somewhere in the middle. We don't try to be so conservative that we're not losing opportunities in order to lower the tax rate. But we're also not going to go and try to hit it right on the dime and put ourselves in a pinch where where the board is forced to have to look at cutting services. So we really do try to go right in between those lines. To reduce tax, debt.
Can we use the $21 million reserve fund to reduce debt is the question.
At this point, none of our debt is callable. It's all either been retired or refinanced. We're just down to two debt obligations, both of which will be paid off in the next 5 years. And the board has done a tremendous job of reducing that debt as low as possible. Every opportunity that they've had, some of those favorable variances that I was talking about earlier, that's exactly what the board chose to do, was to retire debt.
So based on current demographics of the Woodlands and with a freeze on the tax rate for the over 65s, how will the city continue to fund services as the population ages? Will the Woodlands become a tax haven for the elderly? Any answer to that?
I don't.
Not sure.
I don't
how to
exactly-
answer.
So what they're saying is that, how has the township calculated the budget to basically incorporate if we gave this tax freeze for the elderly? How will we be able to sustain financially in the future, right? And so within the first 5 years, we have already calculated that debt conservatively, so it's already incorporated in the 5-year plan. So that means going forward, pushing out, we will continue to do so every year for the next 5 years of our 5-year plan. So we always look at that 5 years in advance every year. So that's how we would handle it. Just as though we handle it for the first 5 years, we will continue to do so.
And I will also say in terms of our revenue sources, the township's really very unique. We only rely on property tax for 36% of our revenue sources. All of the other comes from additional revenue sources. Sales tax, we have a fantastic sales tax base. And so we rely on that heavily. We also have contract revenue, we have grant revenue. The board spends a lot of time making sure that we maximize every other type of revenue source, and the property tax is the last piece. So again, it's just we know we've already built in for the tax freeze. It increases. I mean, it does. Every year it increases. It goes like that, and that's exactly what our model shows. We haven't kept it flat. We know demographics are going to change. We know revaluation affects it, and so we've built that incline into the model.
So before we take the next one, I know we only have about 10, well, when were we coming back? We only have a couple minutes left, if that. Has everybody had a chance to fill out a card? Because if you have not yet asked a question and haven't filled out a card, I want to be sure we capture that. Okay. And I guess we have time to maybe take one more. So Monique, this is, it's related to planning for audits, the plan to audit the finance plan ongoing and then after 5 years. Can you just talk a little bit about audits, the plan to audit the financials on an ongoing basis and also after 5 years?
That's actually something we do daily. I mean, that's our job. So it's an ongoing process.
For 8 o'clock, I know not all the questions have been asked.
Thank you. And again, if you didn't get a chance to write a question down, please do so and we'll follow up on that.
And if everybody here at the table, as we rush you out, we're all available for questions after this night. So please feel free to reach out to me or anybody else.
Website.